Hello and welcome to CNBC TV18 Mumbai Newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh. You're watching Mutual Fund Corner. And today the show is going to be all about mutual fund queries. We got a lot of them this time, Pavitra. Yeah. So let's get in our guest for the day and he'll be answering all the queries.
Oh, absolutely. And we've had so many queries which have come through on, all of our social media platforms. So we have Harshvardhan Roongta joining us. He's certified financial planner at Roongta Securities to, really take you through all of these individual queries that you have sent in. Harshvardhan, as always, thank you for joining us. I know you've helped us with many an episode like this where, we've got queries coming in, but let's get straight to it. The first one is from Vikram, who writes in from Mumbai. He asks whether he should continue his investments in the Axis Small Cap Fund as the fund has been underperforming its peers. This entire category has got so much attention, right? Because of the kind of moves that we're seeing in the small cap index. The flows have been really solid as well. But do you think the Axis Small Cap Fund is a good pick? And if someone is already invested, would you recommend that they move to some other fund or stay in this one?
So Pavitra, if you look at the Axis Small Cap Fund and you just analyze the fund by itself.
Yeah.
So if you see the returns, there could be certain amount of underperformance in the short term, but in the long-term averages, when you look at the long-term averages, when you look at the risk ratios, when you look at, say, probably the standard deviation of the scheme, you look at the Sharpe or the Sortino ratios, there's nothing alarming in this scheme that you would need to look at and consider that should I move out of this. Besides, as I said, in the short term, you may find that some fund managers may underperform and somebody may do well. That's very much possible in the short term for a simple reason, because the short term performances will be dictated by what kind of securities you're holding and what action has happened on that in the immediate near future. So that could impact the performance in the short term. However, when you look at the long term average returns, the scheme has done well when you compare it to the benchmark or when you compare it to other funds in this category. So I don't think there is any reason for Vikram to make any changes at this juncture. I think he'll simply continue with it, and probably because we are talking about small cap as a category, you may want to actively monitor it. So 6 months later, he could again look back at it. Not now.
Okay, so you're asking him to at least review it after 6 months and keep at it at least for the next 6 months and see which way things go for this particular fund for our viewer. The next one is coming in from GM Kumbhar. He's writing to us from Chennai, asks us which mutual fund is right for the long term for purchasing property and some risk funds he can explore as well. I know, Harshvardhan, it doesn't have the exact long term that he's talking about or the amount that he's looking to invest, but if someone does have some goals in mind, how do you suggest them that they should go about it?
Sonal, you're absolutely right, because he just simply mentioned that he needs for long term. Now, you'll be surprised to know that each individual has such different definitions of long term. I was just chatting with some people and they said that, I want to invest for long term. And I just inquired how many years. So they said probably a year and two. On the other hand, there is somebody else who talks about long term being at least 10 years or 15 years. So what is important for Mr. Kumar is that first he needs to identify what is long term for him. So I don't want to jump the gun and assume myself. However, your generic question that we spoke about long term, in my mind, the long term is always 8 to 10 years. Yeah. So if you're talking about an investment period for more than 8 to 10 years, then most certainly equity as an asset class is the best product to invest into. Why? Because equity has the potential to generate higher returns, and that is eventually the objective of investing. If you're investing your money, you have to generate returns which are in excess of inflation, and only then will you create wealth. So equity is the only asset class that helps you do that. And of course, you invest through SIP if you do not have the risk appetite, but you can go in through SIP because that averages over long term. Further, how do you create an equity portfolio? Well, you need to diversify across different market segments. So there will be a large cap, mid cap, small caps. Each individual should basically look at the risk profile that they have and then allocate between large, mid and small cap. So I think that essentially would be the methodology to accumulate wealth for long term. Now, in the absence of any such information being available to us, I would suggest Mr. Kumbar to meet somebody, a professional or a planner in person and design a portfolio which is most appropriate to his risk profile rather than just putting money into some schemes that you've heard of. Meet a planner, talk to them, and design as per your own risk profile. I think that will be the right appropriate way to go about it.
Okay, got that. Hopefully this helps our viewer, and also hopefully they are considering 8 to 10 years when they talk about a long-term investment and not a one-year period. But we get that a lot as well. The next query comes in from Ravi Kumar. He writes in from UP, and he wants to know if it is a good time to invest in long-duration debt funds. He writes, as interest rates may decrease in the future, how will it affect debt funds, and what is your view on the Nippon India Nivesh Laksh Fund? Harshvardhan, what do you think about debt funds right now and long duration debt specifically at a time like this?
So, Pavitra, Mr. Ravi Kumar is kind of right on his thought process where he says that he's estimating interest rates to, ease out in the near future. So, my view is that in the next 2 to 3 years, you may find interest rates definitely lower than the levels they are at. And the good part with debt mutual funds is, when interest rates fall, you will see capital gains coming into effect in your debt mutual fund because the prices of bonds and interest rates are inversely related. When the interest rates will fall, you will see capital appreciation. Now, this capital appreciation, there will be an impact, right? So it's more like a pendulum, the shorter end. So if you're at a shorter duration funds, the capital gains will be limited. And if you are in the long duration funds, the capital gains will be more. So very clearly, if you estimate that interest rates are going to come down, yes, it makes sense to be in long duration funds. Now, do you continue to be in long duration funds after the interest rates have come down? I'll answer in the second part when he talks about the Nivesh Lakshya fund. So very clearly, if the gentleman is assuming that interest rates are going to come down, yes, it makes sense to be in long duration funds. Now, when you talk about Nivesh Lakshya Fund, now Nivesh Lakshya Fund is essentially, if you see the macular duration of the fund and if you look at the average maturity, the macular duration is 10 years and the average maturity is 20 years. So essentially, Nippon Nivesh Lakshya Fund is a very long duration debt fund. It is ideally for people who are looking at absolutely 20 to 30 year time horizon and having a debt allocation. If you're playing the interest rate cycle and you want to benefit out of it, I think the better way would be to go for a medium to long-term debt fund. Now, it need not be a very long-term debt fund. So what is a medium to long-term? Now, if you look at SEBI definition and what SEBI mandates a long duration fund to have a macular duration of approximately 7 years. Now, what happens in this case when you go for an open kind of a scheme and not a roll down, like Nivesh Lakshya follows a roll down strategy? It also means that whatever they are going to freshly invest is going to go in the same securities, which means they will have long duration maturities. Now, in the other long duration, medium to long duration funds, the discretion is of the fund manager. So say this interest rate cycle that we're looking at as eased and now you've made the capital gain. The fund manager has a discretion to either decide that you want to stay in a macular duration of 7 years or even change it. Whereas in Nivesh Lakshya, what happens is they are mandating their own selves to have a very long duration. So they don't have a choice to reduce the macular duration of the scheme, even if they want to, because they're following a roll down strategy. And in the other case, they are not mandated to any such fixed objective as they have set on themselves. So what I recommend is that it will be better to be in a medium to long-term debt fund other than the Nivesh Lakshya. My suggestions would be a UTI bond fund. You could choose an SBI Magnum income fund or an ICICI bond fund. So these are the options. Though the macular duration currently will be lower than that on Nivesh Lakshya, however, it is better for a layman investor to stick to something like this rather than going for a Nivesh Lakshya kind of a product, wherein you will have to time entry and exit, which may be difficult in the future.
Okay, so that is very helpful and very comprehensive in terms of what he should do with the fund that he has, the entire category, and what the other options that our viewer can actually look at when he's considering investing in long duration debt funds. Harshvardhan, we'll do one thing, we'll slip into a short break. When we come back, we'll answer more mutual fund queries on the other side. Stay tuned for that.
Hey guys, welcome back. You're still tuned into MF Corner here on CNBC TV18, and we still have Harshvardhan Roongta with us to answer all of the queries that you have sent in. So let's get to the next one. We have Abhijit Roy, who writes to us from Kolkata. He invests 6,000 rupees per month in the HSBC ELSS fund. He's saying that he's been investing in this one since 2015, and he aims to build a corpus for his child's education by investing in this with a 10-year kind of horizon along with the ATC investment. He wants to know if he should continue in this fund or switch to a similar fund providing, tax saving and capital appreciation. Harshvardhan, come in on this. How do you look at the HSBC ELSS fund? And also, when you are saving for an amount like this, which is for a child's education, do you think ELSS is a good path? Would you recommend, a children's fund, or would you just look at, straight up an equity fund, which along, that kind of time horizon can sort of minimize your risk quite a bit? So how would you approach this?
You're absolutely right, Pavitra. So, this second part of the question, which is whether you should use an ELSS scheme for educational requirements of your children. So just one point that needs to be highlighted on this aspect, then I'll come to the HSBC ELSS fund, whether you should stay invested in that or not. So I'm happy that you brought up this question. For a simple reason, ELSS has a lock-in of 3 years. And if you're investing in through SIP, every installment that you pay gets locked in for 3 years. So which means that if there's an investment that you're making in August 2023, this investment will be free to redeem in August 2026. Now September 23 will be September 26. So you're never going to have the complete access of the fund at one go. It is going to come to you in every month. Some portion is going to get released. Now, when you talk about educational needs, you will need to pay your semester fees on a quarterly basis, half yearly or a yearly basis, spread over 4 to 5 years. Now, in that case, ELSS could potentially work. Why? Because all that you're going to be able to redeem is the one that is free, which is done 3 years ago. So if you need money 10 years from now, all the investments done for 7 years from now will be eligible for redemption, not in the last 3 years. So that is the cash flow that you'll have to manage. And if you're able to do that, then it's fine, because anyways the fees are going to be required to be paid in 3 to 4 years. So I think that aspect taken care of. Secondly, why ELSS and not any other? So ideally you should go for an without non-ELSS scheme, because you have the liberty to withdraw all the money. But in this case, Abhijit has very clearly stated that he wants tax benefits under Section 80C. So if he wants benefits under Section 80C, there's no other choice but to invest into ELSS. So that combination, ELSS could work. Now, coming to the HSBC ELSS fund, well, there is a scope for him to make changes. And the fresh investments that he makes, I could recommend 2 schemes, and he can pick any one of them. For a 6,000 rupees, he does not need 2 schemes. So he could either choose the Mirai Asset Tax Saver or a Kotak Tax Saver. So just pick any one of the two, whichever he's comfortable with, and you can start investing. Now, interestingly, all the investments that he's made in HSBC ELSS in the last 3 years, there is a lock-in, as I said. So you can't make any switch over there. For the ones that he's made from 2015 to 2018, there is an option to withdraw, but I would suggest don't make any changes right now, for the simple reason there'll be huge tax impact, and you must give it some more time. Probably the scheme will start performing better in the future. If not, then take a call at that point in time. So as of now, all the existing investments in HSBC can stay as it is. Fresh investments could go into Mirai Asset Tax Saver or the Kotak Tax Saver, whichever he's comfortable with.
Okay, all right. So that is about the ELSS space. Has been in focus for a number of reasons as well, the new tax regime and a lot more. Moving on to the next query that we have, Amanullah Khan writes to us from Mumbai. He's unable to redeem his holding in Nippon India Small Cap Fund. He needs fund for his personal expenses and wants to know what he should do. This looks like a different case, Harshvardhan. How do you address this? Is it a technical issue or is it something related to the fund itself?
No, so as far as the scheme is concerned, I mean, Nippon hasn't put any restriction, and in fact, no fund house in that sense could put in a restriction saying that you cannot withdraw your money. That's not the case. So he can most certainly, he's eligible to withdraw. Now the question arises, why is he not able to withdraw? Because, I mean, there could be multiple reasons. So first, the step would be, of course, to find out from Nippon as to what is the reason he's not able to withdraw. Why are they not affecting his redemption? In my mind, there could be a couple of reasons. One is, of course, his KYC is not done. His KYC is not updated in the record. So as per SEBI regulations, I mean, if you do not have your KYC approved and verified and validated, then you are not allowed to redeem out of your scheme. So you'll have to check if your KYC is updated or not. If not, you'll have to finish your KYC process, and then you'll be eligible. In case you're trying to read, if your KYC is updated, but you're trying to use the online platforms, so wherein you're just logging into your CAMS, Carvi, or you're logging in online and trying to redeem through other platforms, well, in that case, check and verify if your mobile number and email ID has been updated in the folio or not. Because again, there is a regulation which says that in case you're using online platforms for transactions, there will be an OTP sent to you for a two-factor authentication. So you punched in your transaction, there is an OTP which is generated and sent to you on your email ID and mobile. In case your numbers are not mentioned or incorrectly mentioned, then you're not getting the OTP, and that's why you're not able to make the two-factor authentication. And that is why probably. So I guess let's not get into the scheme saying the scheme is not permitting it. I think there is some technical issue which he needs to sort out, for which the best way would be to find out what is the reason and then probably fulfill that requirement.
Yeah, it definitely doesn't seem like this is a scheme kind of problem, but I hope that this helps our viewer. The next query we have is from Mayank Gupta, who writes to us from Indore. Now, he says that small cap funds usually look enticing when compared to other categories and the returns that they generate. He wants to know if it is a good bet considering the volatility in the market. Harshvardhan, the interest that this category has seen in the past few months is no joke. The kind of flows that we're seeing is just going up, month after month. But what would you recommend to someone who is looking at this space? Take us through both if someone is, say a medium-term kind of investor and also for the long-term. What would you recommend? And do you think that, what portion of your portfolio perhaps do you think that, small cap should occupy?
Again, a very relevant question, because the times are such where we are seeing a lot of interest in the small cap category. Now, if you look at the investors, mindset or the psychology and behavior in the market, when the small cap returns, when the small cap category starts giving you stellar returns, so you will see on all the comparison sites that small caps have generated, say, probably a 30% kind of an annualized return, etc. That layman investor wants to then jump onto the bandwagon and assume that this is the kind of return I will make even in the future. Well, there is absolutely no guarantee of any past performance being repeated in the future. And unfortunately, people tend to forget that. So there has been a good interest and good run up in the small cap category, but does not mean that this is the kind of returns you will get in the future as well. So it's very important to understand what is a small cap. So small cap by definition essentially are all those companies which are 251 rank as per market capitalization going up to the bottom. So there would be about, say, 5,000 companies listed. So 251 in terms of market capitalization going up to end of 5,000 companies. All these fall under the small cap category. However, most important is how many are investable companies. So most of the fund managers will invest only into probably 200 to 300 companies in that category itself. So not that all companies are investable companies. So nevertheless, having said this, as a layman investor, you must have an adequate and a proper appropriate asset allocation. So in asset allocation, I mean debt equity. Within equity also, you need to diversify. You need to allocate between large cap, mid cap, small cap, and this allocation depends entirely on your risk profile. So if I'm a conservative investor in an equity side, I will have more into large cap. I will have less into small cap. And if I'm a very aggressive investor, I'm a knowledgeable, informed investor, I want to take that additional risk, then I will have a higher allocation in small cap and lesser in large cap. So this is going to be very personal in nature, rather than being a formula that has been given all across the board saying that because small caps are doing well in the long term, it has potential. I don't think that's the right way to allocate towards small caps. So what investors need to keep in mind that do not get swayed by the past performances, but look at what you need to do as per your own risk profile. Yes, you could have a small cap allocation, but that need not be very large. It could be probably 10 to 15 or 20% of your equity portfolio. But again, as I said, it has to be more personal in nature rather than looking generic. And do not most certainly get swayed by what returns a particular market segment has given, large cap, mid cap or small cap, and allocate towards it. That's not the right way, because past performances will not repeat in the future. I'm not saying may not repeat. I mean, they will not repeat in the future. So let's not get swayed by that. Look at your own self. Large caps are least volatile when you compare to mid and small. Mid caps will be more volatile than the large cap, and small caps will be more volatility than mid and large cap. So you'll have to be very careful on those counts and then create a portfolio.
Okay, all right. Thank you, Harshvardhan, for joining us and taking us through all the viewer queries. I'm sure that was really helpful. But with that, we'll take your leave on this edition of Mutual Fund Corner. Stay tuned to CNBC TV18 for more updates.